You're listening to the Reinvest Podcast, where each Tuesday we will show you how to reclaim, reconnect, and refocus your life by bringing you the top real estate professionals in the industry. We'll pull back the curtain so you can implement these tools and tactics to build generational wealth. Your hosts, Garrett Gatton and Seth Ciminillo. Hey guys, welcome to episode 59 of the Reinvest Podcast, where we get to show you how to maximize your life through the power of real estate investing. We are in the studio again, live with a regional investor, just a stone's throw away from us, Phil Moeller with Moeller Real Estate. How you doing today?
I'm great, man. Thanks for having me here up in Lima. A 40-minute drive, not very far at all. So
that's the definition of the Midwest.
That's right.
You can get anywhere in like 40 minutes.
You got a nice little studio here. It's pretty nice.
Yeah, awesome. We how many years ago do we do this?
Year and a half ago? Or the studio?
Yeah.
Not very long ago. We started in the 5th floor of a downtown building, and we had a lifetime white table set up with USB mics in a dream. That was about a year and a half ago.
Humble beginnings.
And then over the last year and a half, we've collected some equipment and added video. So it's been a lot more enjoyable to even do. So
yeah, it's been cool to see even, with the evolution of our podcast, also kind of the evolution of some of the guests that we've been able to get on.
Yeah.
And relationships like yours has been proof of that. Excited for today. So you'd come down to our meetup a couple months ago.
Yep. And
spoke with our investment group here in Lima. Had an awesome reception. Honestly, I think that probably was one of our best meetups.
They only say that because I wasn't there that month.
I'm sure you tell all your guests that.
Yeah. Yes, you were our best. You were our best guest. Yeah. They're like, wait a minute, how many best can you have? That's true. That is a very sales thing. Honestly though, that was one of the best ones.
Good. I appreciate that.
Scouts honor.
Just don't listen back to the other podcasts.
Yeah. Right. Exactly. I also wish that you guys had audio only because for anyone that does watch video, the balding look, I'm better sound than video.
You're sporting it well though.
Yeah, and you've got the beard. That's kind of a good look.
It looks sporty.
It's the distractor. That's the key.
There you go.
So you've had a lot of success over the last few years, and hoping to unveil and kind of unpack that for our listeners today.
Yeah.
You're at 350 doors right now of a variety of different real estate asset classes, which we'll get into here. You started investing in 2013.
Correct.
Were you an active investor before you were a passive investor or vice versa?
Active. So if we go back, my story really started in 2010, quite frankly. I started looking at real estate and wanting to buy real estate probably in the 2010 time frame. Engineer by trade, very analytical, so just analysis paralysis. I didn't pull the trigger on my first investment until 2013. Good timing in the market. 2010 would have been better, but no regrets. I made that plunge, and from 2013 to 2017, was investing in single family houses and duplexes, kind of small stuff
in Sydney, Piqua area.
Sydney, where I worked at the time, is where I started, and just honestly simple stuff: 3-bed, 1-bath, maybe 2-bath. Really, brick ranches have been the ones that we've held the longest. So just have had good luck with those. The market's helped, of course, over that time period, the last decade. And then in 2017 was kind of a shift point where I don't know if we're up to 20, 25 doors, something like that in single family and duplexes. And we're thinking, okay, do we do this 25 more times, 50 more times? How do we scale this to the next level?
Right.
There might have been a story in there where my wife said I didn't sign up for this because she was helping management, which was, interesting because one of the reasons we got into it was to help her work less. And now I created another job for us. But in 2017, we shifted to multifamily, and really that's been our core focus. Especially from 2017 to 2021, some different deals in contract. We still hold a lot of those. We've sold some of those multifamily properties. And then in 2022, I did a lot of passive investing just because your access to deals is so much broader, right? If you think about multifamily, your access to deals is local in your market or where you have relationships or management potential.
Right.
I partnered up with a group of guys that were looking at passive investing and had a lot of years of experience. So I did a lot of that in 2022. and even in 2023. And now through all of that, learning of both multifamily, how to operate, how to run those, how to find those deals, how to, the perspective of a passive investor shifting now to looking for larger multifamily deals that we also syndicate or bring investors in and give them an opportunity to work with us.
So where within that timeline, were you still working your engineering job through most of that time, or when did you drop that off, or are you still working your engineering job?
Yeah, good question. I always kind of had the vision. First goal was really for my wife to work less, but I always kind of had the vision to be my own boss and work for myself. So in 2021, so I was in engineering and then product management and different roles within the company. In 2021 is when I left my corporate job permanently to focus on real estate. And coincidentally, 2021 is probably my biggest acquisition year too, just because of another level of focus.
Yeah.
And
that's
an ability to network and find deals.
I think, behind everybody's real estate investments is a purpose. And it's, your initial purpose was a family goal of my wife working less. Maybe was that to stay home? And
yeah, we just had our
kids?
First child, I think, a few months before that. So we just, a lot of discussions and maybe, dreaming, planning, goal setting, whatever it might be. And we're like, okay, she had a job that was evenings and even Saturday mornings. So like, how do we slowly start to step that back so she could be home more with her family and help raise her family?
Obviously you guys are way past that of accomplishing that goal. So because I feel like that's pretty relatable, and when you have success, you start with a goal, which is natural, gives you a direction to head in. You need, gives you metrics to go for. When did that goal or dream get a little bigger?
Yeah, I think so. First of all, I think having a vision or a goal or, just thinking bigger is really important. I encourage people to always think about that, write those things down. The next thing I would say is, you're kind of alluding to it, but you can't connect the dots forward. So if I think about where I was then and trying to connect the dots to where I am now, it's hard to do that. So when those dots changed or when that goal got bigger, I guess, was really a couple of different phases. First, when we just bought the first house, because I mentioned analysis paralysis.
Yeah.
And
get off the sidelines, get into the game.
Take action, right?
Yeah.
So you can think about things, you can plan, you can educate yourself, you can associate with others, but you got to take action at some point. And when I bought the first house and I realized, okay, this does work. Yeah, I'm paying down principal. Yeah, there's cash flow. Okay, the market appreciated a little bit. Maybe the appraisal came in. I was like, okay, it clicks. So
proof of concept.
When I, waited maybe 2 years to buy the first one, I waited 4 months to buy the second one.
Yeah,
4 months,
that's interesting.
Another 4 months to buy the third one. So that was a mind shift. And then I think the other mindset shift would have been when we decided to go into multifamily. And again, not just the decision to do it, but when we actually did it and we started to see the results of that over the first year of holding multifamily and the value add component.
Yeah.
That's when it's like, oh, now we can really do this at scale, and we don't have to, for 50 doors, we don't have to, have 50 different transactions.
So you bought at a really good time too. And so it's like tongue in cheek, because I hate it when people are like, oh, you just bought it at the right time, as though that was the only factor working at that moment that led to the outcome. That wasn't. You guys, there were so many other variables, the past success, the research you did about multifamily prior to getting into that, the management experience that you had from the single families, that all
and it all goes back to like the time in the market versus timing the market. You know what I mean? You were just in the market. You were going to be in the market no matter what. It wasn't like, hey, I see interest rates are coming down again. I see that things are starting to appreciate. So now I'm going to try to time the market and jump in. You were just already in the market and got to take advantage of all of that, which is what, we're all supposed to do. You're supposed to just get in and kind of let everything else
learning process.
Start the learning process and let everything else kind of fall where they may.
Yeah. So first of all, that first deal, it didn't change my life because of the cash flow or anything we made on that deal. Is because the
first multifamily deal.
Either one.
Yeah.
Single family is because the lessons we learned from that deal, right? And then, people ask about timing the market. Where's the market at? That could be a whole episode in and of itself, right? But really, structuring your debt is really important, just being conservative no matter when you enter the market, and making sure the deal works for the market you're in, and not making assumptions on decreasing. Don't assume rates are going to decrease or cap rates are going to decrease. Don't
Right.
do things that are don't assume things that are out of your control.
Yeah.
You can hope for them, but you can't plan around those things. So, the nice thing about real estate is a lot of time it's not timing the market, it's the time in the market. And if you make a smart deal, it might not have a great return in a 2 or 3 year time period if you sold that. But if you have good debt structure, you run operations well, time in the market will likely forgive you, where in 5 years, 7 years, 10 years, you have flexibility as to when you can exit if you want to exit. And it's just forgiving long term, quite frankly.
So how many units was the first multifamily property you guys bought?
Yeah, 48 units.
48.
What
was the purchase price on that?
Low.
Yeah, I know.
It was
40 a door.
No, 18 maybe, I don't know. 680,000. We found it at a real estate investment meeting. Someone was looking to help fund it. It wasn't in a great market. I mean, Xenia, Ohio, there's a whole story behind this. We could go there, or we can go do it later, I know. But the key, one of the messages there is 48 units would sound massive to go from a single family or duplex to 48 units by yourself. Right?
Yeah.
Big jump.
We identified a person that had the deal, but then my partner and I went out and identified another person that had experience in multifamily, had been doing it for 3, 4, 5 years. We brought that person in. We gave up equity. We gave up some of the deal to partner with someone that knew what they were doing. And that it probably got me over the hump, because I don't know that I would do a 48 unit myself the first time. And then we still made mistakes. But it worked well. We sold that deal 13 months later.
Wow, that was a quick turnaround.
Yeah, it's because we were in a market that we probably didn't want to be in long term, and we were like, okay, if we have an exit option, let's do it.
Take it, yeah.
You make mistakes, and we made plenty, but identifying partners to work with that have experience, that are maybe ahead of you. Was probably what helped us a lot on that.
Man, that's really good, because I think anybody who's investing, you have that hunger, that drive, and there's that temptation to try and take the whole bite yourself. And it's kind of counterintuitive to say, well, what if I were to share this and take less, to go farther, right? But you had the long view in mind. You weren't trying to get rich off of one deal. You wanted to build a foundation on how to operate multifamily, get into the space. Did that guy provide the value you hoped that he was going to?
Yeah, and honestly, for sure he provided value. I also think, especially me being more conservative, analysis paralysis, it just gave me the confidence to do it in the first place.
You saw how it played out, and you were like,
yeah,
I can do this now.
Right.
Yeah, it's repeatable.
Right. And then also the risk of that deal is diminished, because you have, there was 4 partners in that case. So anytime you're looking at taking action, especially for the first time, what's the best thing that can happen? And we did well on that financially. The best thing is the confidence to do multifamily, quite frankly. And also, what's the worst thing that can happen? And you just, look at the worst things, look at how you might mitigate those. What are your options? What are your exit options you have if the market crashes, whatever it might be? But the best thing that can happen is, you can make money on a deal, but it's usually the network you build, the education you get from just taking action.
So one of the ideas that we wanted to dig into today was the idea of horizontal income streams. And so you had given us you started in single family, you moved to multifamily. And so what are some of those other things that, as you started to grow, that you were able to diversify, instead of maybe just sticking in single family, like you were saying, it's a vertical income stream. All your eggs are in that residential basket of single family houses. There's multifamily offers something different asset classes, offer different protections in different markets. So can you maybe give us the journey of that as you started to branch out and diversify within real estate, and even some of those assets maybe outside of real estate, if you have any?
Yeah. So first of all, maybe to define horizontal income streams for the audience, I look at vertical income and horizontal income. Vertical income, if I work 40 hours a week, 50 weeks a year, 2,000 hours a year, basically in 2023, I get paid for that time, and that's vertical income. If I stop doing that, the vertical income goes to zero, right? Whereas if I spend a lot of time in 2023 making investments or passive investments or creating different horizontal income streams, theoretically, if I stop working, it'll pay me in 2024, 2025, 2026. Now, there's also different I'll say there's this spectrum of vertical and horizontal income. So I would call like a W-2 job is very vertical income,
right?
Where horizontal,
there's a direct correlation between your time and what you get paid.
Where a horizontal income, like a limited partnership investment, it's very horizontal, but quite frankly, you should still educate yourself and spend some time learning that space, even though it's passive. Once you place it, then it's completely passive, but there's still some work to do. It just pays you over time. So that's kind of set the stage of vertical versus horizontal, and there's this spectrum of it, even within real estate. Flipping houses is relatively vertical income, for example. For me personally, my first 4 or 5 years was buying houses, and each of those might be an income stream. Maybe the cash flow 100, 200 a month, whatever it might be. Then we shift to multifamily, so that first 48 unit, that is another horizontal line of income that I have created, put the investment up front, and then it's relatively passive.
Yeah.
So the next phase was multifamily, and then in 2022, when I mentioned earlier, there wasn't really as much access to deals locally just because of the interest rate environment, seller expectations versus buyers, what they wanted to buy for.
There was a big gap there.
I partnered up with some different people, and that's where we started diversifying our investments. So, I've invested as a limited partner in, maybe a land deal, mobile home park, self-storage deals, development deals, multifamily, of course. So I've diversified in different asset classes.
Yeah, and geography.
But different geographies, different return profiles, which can be, if you're really interested in passive investing, a development deal, the return profile is you're probably going to not see any cash flow for 2 to 3 years.
Right.
And then there's going to be maybe 2 years of really high returns of capital, and then the money you make. There's not really cash flow from that.
Yeah.
A multifamily deal might be 5, 6, 7% per year cash flow. And then if it's a 5-year exit, maybe that triggers it. There's, like I'm invested in ATM. ATM, it's consistent monthly cash flow every month, but it's not really growing in equity long term.
Right.
So there's ways to diversify asset classes and the types of returns that you can get depending on the type of investment. Land's another one. Like I'm in land deals where the projection is we buy it, zero cash flow. They're going to reposition it, do the entitlements and all the work, and sell it in 12 to 18 months. So there's all types of different ways to just generate different income streams that also diversify markets, diversify the types of cash flow, asset classes. Like there's a lot of different layers of diversification, if you will.
That's why real estate and really just investing in general is fun, because there's a lot of levers you can pull. And to your point, going back about the goals, if you don't know your goals, then you're not really going to know what kind of diversification you need to pursue. You might, you shouldn't just take what's in front of you. With technology and everything, there's so many resources available for you to pursue some of the different types of investment vehicles that you're talking about.
And honestly, that's, I'm biased. So my core is multifamily, and that provides cash flow, maybe not the highest cash on cash returns, but cash flow plus the equity multiple or equity growth as well. So if it's a reposition.
I know it's kind of on the topic of horizontal income, but it's one of those factors, one of those benefits of real estate that's working in the background. We always focus on cash flow. We focus on appreciation, leveraging equity. So how did those multifamily investments and the equity that you created there through the market appreciating or forced appreciation and repositioning those and making them nicer, how did that give you the ability to pursue multiple layers, of other income streams?
Yeah, great question. First of all, that is the nice thing about real estate is time in the market provides different ways to build equity, cash flow, market appreciation, forced appreciation, principal pay down, right? The tax benefits. There's a lot of ways you can make money in real estate. All those different ways to make money build equety, and those stack up. If you think you're going to get rich quick in real estate in a year or two, it's not going to happen.
Nice try.
But the snowball can roll, and it gets bigger and continues to grow to a point where there's a book, Equity Happens. It does. It takes time, but it does. And once it does, you have ways to leverage that and put that equity to work. Like one metric that I pay attention to is what is my current return on equity on a deal. So if I've held a deal for 5 years and I have a lot of equity and very low cash flow or growth in that, my return on, it's kind of, I don't want to say dead equity, but it's not working very hard for me.
Gotcha.
So I'm going to look for ways to make that equity work harder for me, but wisely, not risky with too much debt or risky debt.
Right.
But I'm going to look for ways to do that. So in 2021, early in the year when rates were still low, we had built up equity. We had forced a lot of appreciation in some of our medium to larger multifamily properties. They were stabilized at that time. We wanted to lock in long-term great debt.
Right.
We did that. We were able to pull some capital out and still have plenty of margin to make sure those deals continued to operate safely, but then take that capital that we pulled out and invest it in passive real estate.
So let me ask you this question, because and for our listeners, I want to maybe explain a little bit of what. So you started buying in 2017, okay? So 2021 is when you refinanced on a lot of the multifamily that you owned?
Correct.
So you'd had a couple years already to pay down the equity or the principal, the appreciation of the market. So, that's moving two directions.
Yep.
To really create that equity increase. And then we were in historic low rate environments.
Correct.
So it was like this perfect storm, so to speak, of how long you'd owned the properties, low interest rates that allowed you to do that. So here's my question. What would have been the outcome if you wouldn't have pulled equity out and refinanced? Because there's people out there that are like, hey, debt adverse.
That was me. I mean, quite frankly, that's how a lot of us grew up, right? Read the book Rich Dad, Poor Dad, but that's not the way we naturally think. Like my mindset growing up and even into my professional adult years is pay down debt, pay down debt, pay down debt.
Mm-hmm.
And there's a time and a place for that, or there's certain types of debt where you should do that. But at that time, again, I was looking at my return on equity, and more importantly, I'm looking at my margin. If I do refinance, do I still have plenty of margin?
Right.
It's debt service coverage ratio, very, very important metric to understand in real estate.
Yeah.
To make sure there's plenty of cash flow above and beyond my debt.
Yeah.
To make sure it's safe. So I had never thought about this. If I didn't do that, that's a good question. I wouldn't know what I know about passive investing. I wouldn't have done it much of it at all, quite frankly. I wouldn't have generated the income that we get from those passive investments today. Those deals would be, cash flowing great. I would have less debt on them and more maybe equity in them. But net, I would not be in the same position.
Because how many assets did you get into? I mean, outside of the passive stuff, from the capital that you were able to pull out when you refinanced?
During that time period, because it was really when we closed on those, I would want to say it was like April and May or April and June of 2021 when rates had started to increase at that time. So we really we haven't bought any assets. We bought a short-term rental.
So you probably still have some of that capital on the sidelines kind of ready to deploy.
We invested a lot in passive deals.
I got
and
you.
then
So
it also helped. It also has helped our liquidity position, which is another thing.
Yes.
People think debt is risky. Well, it can be if you do it poorly.
Right.
But lack of liquidity can also be very risky, right?
Yeah, absolutely.
So just, I bet a lot of people, if they could take on 4% debt right now,
would scramble to do it.
To boost liquidity would be interested in that. So just those are, liquidity management is also an important aspect of all this.
Yeah. I think that's why you have to filter the advice that you're being given, right? Because there's the Dave Ramseys of the world out there that are very helpful to a certain type of person.
Yep.
But if he's the only voice speaking into your finances and your investment strategy and thesis, then I think you're getting a narrow-minded, a very narrow lens. On the flip side, if you're listening to somebody who's very aggressive and doesn't understand, if someone hasn't been in the market through a downturn, then take with a grain of salt of what they're telling you.
Correct.
Because their strategy hasn't been fully tested for a full market cycle.
Yep. And so that's a good point, because I do think the Dave Ramsey mindset is a great mindset for certain people that need that, right? If people aren't taking any responsibility, aren't saving in any way,
illiterate with their finances.
Yep, they need Dave Ramsey. But there's a point where you maybe graduate from that and you start to think about, okay, now I want to.
You go from Dave to Robert
Kiyosaki, right? And you have that mindset. And I think we all, like you said, we all have that natural. We were trained and educated on the Dave Ramsey approach, so that's always kind of in the back of our minds.
Right.
But shifting over time and in different phases, I think to maybe more. I don't want to say savvy investing, but just maybe more advanced, but not jumping to the most advanced one unless you really have someone holding your hand that's been through all the different phases.
Well, your story is proof of it's that slow incremental, we're talking about a 10-year runway of you investing in single family.
Being consistent.
Now, exactly.
Right.
And then we didn't even talk about, the resources and the people and the networking that you surrounded yourself with to grow and learn through that time period as well. It wasn't just from the deals you were doing. It was those other things, which I think is very important for people.
Yeah, absolutely. I think people should have vision, purpose, goals. Think about that. But then it's really your education. How are you learning about what you want to do? And who are you associating with that's either done that or at least doing it with you, so you can just surround yourself with like-minded people or people that are ahead of you to accelerate your path to it.
Because we all know this, but what goes in is naturally what's going to come out. So if you're feeding yourself with that good information, with learning, that's naturally going to start coming out of you in the way that you're reacting to deals coming your way and the way you underwrite. And you'll be able to see opportunities in a different light. So that's a good point. But go ahead.
Can I just interject real quick? There's some weird, kind of laws of the universe. So you had mentioned when you did your first deal, it took you 2 years.
Yep.
Your second deal was 4 months later.
Yep.
And so something shifted, and then it's almost like there was this magnetic, nature of these deals. Something shifted in your brain, so it was happening more subsequent. The same is true with relationships. When you put yourself out there and start forming relationships with the right kinds of people, all of a sudden you start finding more of those types of people.
Yep.
And I don't understand. We need to come up with a name for what this weird law is, but it's pervasive kind of across the board.
Yeah, I think there's a lot there. That's really good stuff. So education and association are really important. When you do that, when you take action, those lessons from the actions are going to be so much more impactful and build even more confidence. You can't just educate and associate. You got to take action. If you just take action, you're probably going to make some mistakes. Right. Hopefully those aren't too big of mistakes because you haven't educated yourself and associated. And that's true in business. That's true in real estate, but that's also true in any area of life. If you want to be a better parent, husband, whatever it is, right, in health, if you're around people that are like that, you're probably going to take action toward that and just improve. So it's there's a guy that I talk to a lot that is like you a lot of times you become who you think other people expect you to be. And when you're around people that have an expectation of you or see a lot in you, you start to become that person too. So there's a lot of power in.
It's kind of like a self-fulfilling prophecy.
Yeah.
And this would be a good segue, okay, to some of the painful lessons that you've learned through our Smaller Pockets segment.
There you go.
So, Phil, this is the part of our show where you tell us, we've talked a lot about your highlights, but we're going to get into the pain, some of the reality and the grit of real estate. What has been one of the worst real estate deals that you've been a part of, and what did you learn from that deal?
So first of all, the big thing about any real estate deal is when you take some action, you get the opportunity to learn lessons, and we have certainly had those. I would say the worst and or most interesting is that first deal we did, a 48-unit apartment complex. Honestly, I don't know how that deal goes if we're not in a growth environment overall. We were fortunate. That was our first apartment deal. It did work out well in the end, but we bought a property, poor tenant base, not a good market, not a good
Was
area.
it Xenia?
It was in Xenia, Ohio.
Okay.
And on day 3 of owning that, my business partner sees on the news there's a butter knife stabbing at the property. And he texts me, and I think he's watching the news with his wife, who didn't know that was our apartment on the news, if you can imagine. He's like, I mean, he didn't
I like
say
how
this,
it was
but
a butter knife stabbing.
it was, because I
You know what I mean?
I
It
looked
wasn't-
up and found the article on this. I'm like, there's the sirens and the cops, and that's our building in the background. Like, what in the what did we just get ourselves into? So,
she's looking at the TV, the wife of your business partner, and she's like, man, that'd be wild to live there. And all the while she was invested in it.
yeah, she had. I don't think she'll listen to this, but I don't think she had any idea, and he didn't tell her. So,
does she know yet today?
That would be a question you'd have to ask him. I can't speak.
We're
for
gonna
him.
get somebody in trouble.
Yeah, but a lot of lessons from that property. We the management company on that property wasn't probably the right management company.
Why is that?
Just proximity. Even it's a 48 unit can be clunky for a management company to run because you don't have
It's
a
too
full-time
small?
person. So it's 100 units is where there's really synergies. I mean, or if you get close to that, but it couldn't afford a full-time person.
Okay, so nobody's on site,
Right.
Yeah.
Or if it was sporadic, like we didn't have a dedicated office there.
Mm-hmm.
We just learned a lot from that. We were reasonably well capitalized, but like early on, on our first couple deals in multifamily, we didn't really completely understand the value of being well capitalized, and when you can invest in a property, how much value you can add to it. So by being well capitalized, you can invest more quickly.
Yeah.
You can improve the operating income more quickly and reposition that property. That's good for everybody. That's good for the community, the tenant base. They have a better place to live, and it adds value. So there was just a lot of mistakes we made on that deal and our second deal, whatever it might be, that we've learned from over the years.
So was it that there were capital expenditure items that you didn't anticipate, or you saw them but they were more expensive than what you thought?
Yeah, I would say we saw some capital items that we did anticipate, and we did some of those, but like just improving the units and turning them, and really repositioning it. We didn't do that. We didn't have a ton of capital. Like we didn't really cash flow a lot. We got an offer 13 months later. So like, hey, we don't have a ton of capital that we want to keep investing in this. So we sold that and we rolled it into the next property. So it worked out. Had we capitalized it, we probably would have done more. Maybe got a higher exit price, but
What'd you sell it for?
I want to say 1.4. Again, split 4 ways.
Right.
But
And you said you bought it for $650.
yeah, but we put a couple hundred into it as well. So we did capitalize some, but we could have done more.
I mean, still. I mean, I wouldn't call it like a triple or a home run, but you got a double out of it.
It worked out well. There's time. That one was a short time in the market. There's a single family that we had for 5 years that just was a headache over and over again. Like we've had some bad deals. Fortunately, we've been pretty conservative with entering into deals, and with time, at worst with time, the market and just real estate tends to work out.
So I didn't necessarily plan to talk about this, but so that was your kind of personal experience of maybe a deal gone wrong, and it still worked out because of some of the fundamentals that you guys operated by. What are some smaller pockets, things, and I'm not asking necessarily for names, but that you see currently, because there are stories that don't turn out well. You were able to still make that a win. What do you see going on right now that would be considered a smaller pocket?
Yeah, I think that what comes to mind is people that are in limited partnership investments that were made maybe in the 2021 timeframe,
when things were frothy,
when rates were still relatively low. The peak of the market, I would say, was like January of 2022, so just leading up to the peak of the market. So people bought with variable rate bridge debt in multifamily, but quite frankly, other asset classes as well.
Right, across the board.
And fortunately for them, some of them interest rates grew so much, and therefore their debt service, where they couldn't keep up, and they either had to do capital calls, or foreclose on the property and really lose some investor capital. And then a lot of them in 2024, if that was 3 years ago, and they took on 3-year bridge debt, they're expiring, where they've been able to meet the cash flow of the property.
Yeah.
But let's just say maybe that's at like a 1.05 debt service coverage ratio.
Yeah.
When they need to refinance in 6 months from now, the banks aren't going to give them all that capital because they're going to want to see a 1.25,
which means you're
minimum.
going to bring money in, or
sell it and hopefully get investor capital back. So I'm invested in a decent amount of deals, and fortunately, I'm in one deal that has like a small portion of the fund is bridge debt, like 25% of it.
Which, real quick, explain bridge debt for our listeners.
Yeah, so bridge debt is 3-year. It's a 3-year loan, but it's variable rate
throughout those 3 years.
Throughout those 3 years. Now you could buy rate caps on those. So some people might have bought rate caps, which means
can't go higher than this.
It can't go higher than this, but you're buying that up front. You're paying down basically points or whatever it might be to buy rate caps.
And it balloons at 3 years.
And then it balloons at 3 years. Some people have an extension on those where you can go like a 3-1-1, but in general, it balloons at 3 years, and your interest rate now is much higher than it was 3 years ago.
Mm-hmm. And that's maybe what they didn't anticipate for was, those. And first of all, I would say this, that was a historic thing for rates to do what they did. Okay.
Yes. Right.
So where was the error because nobody probably forecasted that into their underwriting, but where was the error?
Because people were probably, at the time, if they're getting a 4% loan or, 3% loan, they're probably still stress testing their model and saying, hey,
if rates
it's possible rates might go to 5 or 6%.
Yep.
But really what has happened, I mean, what were they how could they have been done better, I guess, with their underwriting? Because no one really expected rates to jump up to 8%.
Yeah, I mean, I would say a lot of really good operators are in trouble because they took on variable rate debt and they didn't buy enough rate caps. In hindsight's 2020. So just because they didn't do that doesn't mean they're a bad operator. But there's things to look for in an operator. Like, do they have liquidity or the balance sheet to overcome that, where they can fix that issue? How good are they at running operations? Because if they were phenomenal at operations, they probably grew income enough to at least cover that.
Right.
Whereas where people are really in trouble is if rates went up and their operations they didn't execute their operation. Because while rates went up, rents went way up too during that time period. They've since stabilized, but they went way up. So if you had a not very good operator and they took that risk, there's kind of two issues there, right? If there was a really good operator and rates went up, they're probably okay. They're not going to get great returns, but they're probably okay. So I would say that's why when you're looking at deals, of course, look at the debt structure. That's important.
Right.
But knowing the operator, knowing their track record, know they've gone through just a lot of different types of deals and had the lessons. It's just so important to really know who you're you're not investing in a deal, you're investing in a person or a team a lot of times.
Yeah.
And I think just to kind of close on that segment is, just lost my train of thought. Yeah.
Well, anyway. While you're thinking on that, we're going to jump into our little nugget segment. So, Phil, what is one practical takeaway or piece of advice that you can impart to our listeners so that they can implement that in their investing business?
I would say that, we talked about education and association. The fact that people are listening to this podcast, I think, is a great start. You're learning from you guys, but also from the guests. So good for people doing that. Get around like-minded people. This just resonates with me a lot. I've said it, but because I'm very conservative or just financially minded, analytical, engineering type, take action. Just know what is the worst thing that can happen, what is the best thing that can happen, and go take action on whatever, if that's real estate or something else, like whatever is eating at you or you're feeling compelled to do, but you're not ready or you don't feel like you're ready. Go take action. You can learn so much from that. And again, it's not about making $200 of cash flow from that deal. It's about the confidence you gain and the lessons you learn from doing that. Mm-hmm. And then I would say that's the biggest one. The other thing I talk about is, anytime you're doing anything, be very aware of your personal brand. You're not like build your personal brand strategically. Be aware you're always building your personal brand no matter what. you're
right. Whether you realize you are or not, people are watching you. People are learning. People are, people listen.
Right.
So
right. And then as you get into different phases of your investing or whatever it is, your personal brand is going to show up one way or the other. So just always being aware of your personal brand and working on yourself.
Yeah.
And doing the internal work to build that is so important.
It is internal. And there's a reason ultra successful people talk about mindset, because, it starts at the core in here, and then everything else externally is an expression of who you are, what you believe, how you operate, the integrity you have or don't have, the grit and the mindset for sure. Hey, let's give you a chance to talk about what Moeller Real Estate is doing, where you guys are at right now, what your focus is kind of in this next season. How can people follow your success?
Yeah. First, I appreciate that and the opportunity. I really talk to passive investors as well as active investors. If there's passive investors out there, we're going to have opportunities in the future. We anticipate we've not had a lot of opportunities in the last 12 months, but that's just the nature of the market. We've been looking at a lot. We've been networking. We've been underwriting. Yeah. We put in some LOIs. There's just been a gap, but I anticipate in 2024 there's going to be some opportunities.
When there's pain for somebody, there's an opportunity for somebody.
Correct. And I'm not rooting for the pain, but I want to be ready for the pain. So I want to have access to the relationships and the capital to make it work in 2024. So that's an opportunity. Of course, the other thing is for past investors, we're going to be launching our own podcast here soon.
Yeah.
So
you have a name for it yet?
The Moeller Real Estate and Business Podcast. So we're going to talk real estate business. We're just going to try to, honestly, for me, it's about leveraging the platform that we have to try to have a positive impact. So I'm excited for that in 2024. And then for active investors, we watch for the podcast. We have a newsletter we do quarterly to try to help inform people. We have a real estate meetup just like you do in Lima. We do it in Maria Stein. So
at the Moeller Brew Barn.
Moeller Brew Barn in Maria Stein, Ohio. So
small affiliation.
Yes. Yep. And some other exciting things coming as well. But
cool.
The best way to find us, www.moellerre.com, or find me on LinkedIn.
Okay.
Awesome.
We'll put that in the show notes. Man, as always, we were excited for today because your success has been tested. You have exciting things ahead of you, and I think your story represents where a lot of people are going or want to go, and so it feels relatable.
It represents where a lot of people have started. Single-family houses. It starts small. You get one property, and you go from there.
So. Yeah. Don't be too tough on yourself. Just get started. Start small and just trust that the dots will connect long term.
Yeah.
As always, excited that you joined us on another episode of the Reinvest Podcast. If this episode added to your tool belt or left you feeling inspired, go ahead and share it with a friend. Stay tuned every Tuesday for new episodes. And if you want to get in touch with us, go to our LinkedIn or Facebook profiles and shoot us a message. Move farther, reach higher, and grow deeper. See you next time.